The opening range breakout. It's one of the most talked about strategies in day trading, simple, exciting, and offering a fresh setup every single morning. But here's the truth, while almost everyone tries it, very few trade it profitably. In fact, if you don't understand the hidden trap behind the orb, it can become one of the quickest ways to drain your account. In this video, I'm going to show you exactly what the opening range breakout is, why most traders fall into the same costly mistakes, and, most importantly, the winning twist that flips this setup from inconsistent to one of the most reliable tools in my playbook. Stick with me until the end, because I'll also walk you through the exact rules I follow, real chart examples, and a risk management plan you can apply immediately, plus how to combine ORB with smart money concepts to find only the highest probability trades. So, what exactly is the ORB? When traders talk about the ORB, they're referring to the opening range breakout. The idea sounds simple. You mark the high and low of the first 15-minute candle after the New York Open, 9:30 to 9:45 Eastern Standard Time. If price breaks above, you go long. If it breaks below, you go short. One clean breakout trade every morning. Sounds great, right? But here's the truth. More often than not, price doesn't give you that clean breakout. Instead, it fakes the move, sweeps the high, triggers breakout traders, runs their stop losses, and then snaps back the other way. Congratulations, you just became liquidity. The second trap? No confirmation. Traders see a candle poke out of the box and immediately hit buy or sell without waiting for the market to actually choose a direction. That's not trading, that's guessing. And the third trap is overtrading. They chase every single breakout as if it's the one. But if you take every setup you see, you'll eventually give back every win you make. So it's not that the orb doesn't work, it's that most traders use it blindly. The key is learning how to spot the difference between a real breakout and a trap. And once you make that shift, the orb flips from inconsistent to one of the most reliable strategies you can trade. Now, most people say you should trade the orb on high volatility assets like the NASDAQ 100, the S&P 500, the Dow Jones, even gold. So let's take Dow Jones as an example and see how this really plays out over time. The concept seems simple. Mark the high and low of the first 15-minute candle, draw your range, and wait. If price breaks and closes above the range, you go long. If it closes below, you go short. You avoid trading inside the box, place your stop just outside the opposite side, and maybe use a conservative 1:2 risk to reward. On paper, that looks solid. But when you actually test it day after day, the cracks show up quickly. Let's look at the last 8 sessions on Dow Jones. We got a loss, then a win, another loss, then a win, a loss, another loss, and a couple more losses. Out of 8 trades, that's 2 winners and 6 losers. The math? About 4% gained, but 6% lost. Net result? Down 0.5% in over a week. Basically, you spent 8 days trading for nothing. And here's why: the orb, on its own, has no context. No trend, no structure, no liquidity. It just says, price broke the box, enter the trade. But the truth is liquidity pools live above and below these ranges. The market loves to fake a breakout, grab stops, and then reverse. If you ignore that, you're trading blind. Now, that doesn't mean the orb is useless, it just needs context. And once you add the missing piece, the strategy goes from frustrating to powerful. Here's how to fix it. So here's the twist, the part that flips the ORB from frustrating to consistent. Step 1. We're not just looking for a breakout candle on the 15-minute chart. Instead, we drop down to the 5-minute and wait for a real breakout. But here's the key: the breakout candle itself isn't the entry signal. That alone filters out a ton of false moves. Step 2. We look for an overlapping fair value gap at the breakout. If you're not familiar, an FVG is a 3-candle pattern where the low of the third candle doesn't touch the high of the first candle. In this strategy, the breakout candle, the one that displaces through the range, has to be the middle candle of that FVG. Even better if the gap overlaps the actual high, or low, of the range. That's the sign of true displacement, evidence that real buyers or sellers are stepping in. Step 3. Once the FVG forms, we don't jump in right away. Instead, we wait for price to retest that breakout level. Patience here is everything. Most traders get trapped because they chase the initial push. We're waiting for price to pull back into the FVG. Step 4. Now comes the trigger. On the retest, we want to see an engulfing candle in the direction of the breakout. That engulfing candle is the confirmation. The market showing you the move is real and ready to run. That's your entry. Let's say we're trading a bullish setup. Price breaks above the range, creates an FVG, then pulls back into it with a bearish candle. When the next candle engulfs that bearish one to the upside, that's your green light. Enter on the close of the engulfing candle, place your stop just below the swing low, and target at least a clean 1 to 2 risk to reward. Now, instead of gambling on every breakout, you're filtering for precision setups. You're cutting out the noise, avoiding traps, and only entering when the market tips its hand. Most traders try to play the opening range breakout in a very common way, but it often leads to losses. Here's what usually happens. Right before the 9:30 market open, they switch to the 15-minute chart on NASDAQ. They wait for the first 15-minute candle to form, then mark its high and low. After that, they drop down to the 5-minute chart and watch for a breakout of that range. If the first 5-minute candle closes below the range, they sell at the close. On paper, this looks simple and straightforward. But in reality, the market often turns the other way, and their position gets stopped out almost instantly. At this point, they start asking themselves why the trade failed. They look back on the higher time frame and notice an order block. They realize the breakout was a trap and that price has now shifted in the opposite direction. So they try again, this time waiting for a bullish 5-minute candle to close above the 15-minute range high. Once it happens, they enter buy, place their stop below the low, and still aim for a big reward. But again, price quickly reverses, and they're stopped out a second time. After 2 back-to-back losses, most traders are frustrated and done for the day. The truth is, this style of trading, chasing every breakout without context, is not a reliable or profitable approach. Now let me show you how this strategy should really be used, the right way to pass prop firm challenges, get consistent payouts, and build long-term success. The rules don't change. We still start with the very first 15-minute candle at the 9:30 open. We mark its high and low, then move to the 5-minute chart to watch how price reacts around that range. Just like before, we wait for a breakout. Here's the difference. When price breaks below, we don't jump straight in. Instead, we look for displacement, a strong move that creates a FVG. Here, after the breakout, the price didn't form an FVG. So we don't do anything and just wait. Since we never got our entry conditions, we avoided a losing trade. Again, when price breaks above, we don't jump straight in. Instead, we look for FVG. Once that gap forms, we wait for price to pull back into it, retest the previous high, and then give us an engulfing candlestick. That's our signal. But here's the key: if we don't get that full confirmation, we don't enter. In this example, price retraced but failed to give us a valid engulfing candle. The next candles also failed to confirm the setup, and eventually the market dropped, wiping out the long idea. As a result, the market didn't give us an entry here according to our plan and rules, but it helped us avoid 2 stop losses and losses. No trade, no loss. That's the real lesson. Avoiding bad trades is just as important as catching good ones. Every loss you don't take is money saved, and protecting your account is what makes you consistently profitable. Patience and discipline, knowing when not to click buy or sell, is what separates successful traders from everyone else. This method shows how patience, waiting for confirmations, and sticking to mechanical rules turns setups into consistent, profitable trades. This is why patience, structure, and context matter so much more than just chasing every breakout. Thanks for watching, guys.